Technical Analysis of the Financial Markets by John J. Murphy. Picture yourself standing on a beach for a moment. The sun warms your skin as you watch the ocean. Waves crash on the shore, one after another. Some tower over the rest, while others barely make a ripple. To anyone passing by, it's just water doing what water does. Beautiful, chaotic, completely random. But you're in on a secret. Beneath those crashing waves, there's something deeper, something powerful, pulling the strings, the tide. It's either rolling in or pulling out. Watch long enough, and you'll spot its fingerprints all over the pattern of waves. The ocean is actually telling you a story. Now imagine the financial markets as that same ocean. Stocks, crypto, currencies, whatever market you choose. Every day brings waves of price changes. A little up, a little down. It looks like chaos. Feels impossible to predict. You'd think you'd need a supercomputer or a team of economists just to make sense of it all. But here's the thing. There's a tide in the market too. A deep, underlying current you can learn to spot, not by drowning yourself in economic reports, but just by looking at the price itself. The market speaks a language, tells a story every single day, and you just need to learn how to listen. This is what technical analysis promises. And for decades, one book has stood as the definitive guide to this language. People call it the Bible of technical analysis. The Market Technicians Association uses it to certify their elite professionals. Even the Federal Reserve has cited it in research. That book is Technical Analysis of the Financial Markets by John J. Murphy. For over 30 years, Murphy has been the steady guide in this world, from leading futures research at Merrill Lynch to analyzing markets live on CNBC. He didn't just write about this stuff, he lived it, breathed it, taught it to millions. Today, we're stepping into his world. We're learning to speak the language of charts. Here's my promise. By the time we're done, you won't see random squiggly lines anymore. You'll see stories unfolding. You'll understand the timeless dance of crowd psychology, the epic tug-of-war between buyers and sellers, the hidden rhythms driving everything. You'll have a foundational toolkit to decode any market in the world, and you'll discover that underneath all that chaos, there's often a beautiful, simple logic just waiting to be found. So let's dive in. Let's learn to read the tide. Before we can read the stories on a chart, we need to adopt a certain mindset. It's really a philosophy, built on three simple but powerful ideas. Embrace these three concepts, and everything else we discuss will click. Reject them, and charts will forever look like abstract art. John Murphy presents these as the absolute foundation of his entire approach. Think of them as the three unbreakable rules for understanding the market's mind. The first rule, market action discounts everything. This is the cornerstone. So let's sit with it for a moment. It means that everything, and I mean everything, that could possibly affect a price is already baked into that price. Economic data, breaking news, political drama, investor mood swings, hopes, fears, all of it. It's already there in that number on your screen. Fundamental analysts study the ingredients: company earnings, industry health, economic indicators. But technical analysts look at that approach and say, why study ingredients when you can just taste the cake? The price is the final product. It's the truth. It's like checking a football game's final score. That score already accounts for every amazing play, every fumble, every injury, every coaching call. You don't need to rewatch the entire game to know who won. The score tells you everything. So if price already reflects everything, then the only thing we really need to study is price itself. This is actually liberating. You don't need to be an agriculture expert to trade corn, or understand central banking to trade currencies. You just need to become an expert at reading what the price is telling you. The second rule, prices move in trends. Sounds obvious, right? But it's actually a direct challenge to the academic theory of the random walk. which claims price movements are completely random and unpredictable. The chartist looks at that theory and says, just open your eyes. A market in motion tends to stay in motion. Newton's first law applied to finance. Once a trend gets established, it's more likely to continue than reverse. This is the whole point. We're not trying to predict the future from scratch. We're trying to spot the current trend, ride it while it lasts, and step off when it shows signs of ending. Our job is being trend followers. Think of the market as a powerful river. You can paddle against the current if you want, and sure, you might make some progress, but it'll exhaust you. Or you can get in your boat, point it where the river's already flowing, and let the current do the heavy lifting. Our job is figuring out which way the river flows. The third rule: history repeats itself. This is perhaps the most human of the three. The patterns we see on charts, studied for over a century now, aren't mystical signals. They're pictures of human psychology. And human nature? It doesn't really change. The way people react to fear and greed today is exactly how they reacted 100 years ago. When we see certain patterns forming, we can say, I've seen this movie before, I know how it usually ends. Because these patterns worked in the past, we assume they'll keep working in the future. The key to understanding tomorrow, the chartist believes, lies in studying yesterday with respect and attention. So let's recap. Price is truth. Markets move in trends. The market's story is humanity's story, and that never changes. With that philosophy as our compass, we can start learning the actual language. And to do that, we need to travel back to the turn of the 20th century to meet the man who first started listening to the market's heartbeat, Charles Dow. Charles Dow was a journalist who, in 1882, partnered with Edward Jones to found a little company called Dow Jones and Company. They started publishing a newsletter that eventually became the Wall Street Journal. Dow wanted a way to measure the health of the American economy, so he created an average of the era's most important stocks, mostly railroads and some industrial companies. Today you know them as the Dow Jones Industrial Average and the Dow Jones Transportation Average. But Dow did more than create averages. He watched them, studied them. And in a series of editorials, he laid out the first coherent theory of how markets behave. He never wrote a book, but his ideas became the foundation for everything that followed. He's the grandfather of technical analysis. His most important gift was a simple, timeless definition of a trend. He said an uptrend is just a series of higher peaks and higher troughs. Picture walking up a staircase. Each step up is a new peak. Each flat part is a trough. As long as you're making higher peaks and higher troughs, you're in an uptrend. A downtrend is the opposite: lower peaks and lower troughs. Walking down a staircase. That's simple. That's the core definition we still use. But Dow added a beautiful layer of complexity. He compared market movements to the ocean, saying every trend has 3 levels of magnitude. First, the primary trend. This is the tide. The major long-term direction lasting more than a year, sometimes several years. Is the tide coming in, a bull market, or going out, a bear market? This is the most powerful force. Second, the secondary trend. These are the waves. They're corrections moving against the tide. In a major bull market, a secondary trend would be a decline, lasting a few weeks or months before the primary uptrend resumes. These waves are natural rhythm. Finally, the minor trend. The ripples on the waves. Daily or weekly fluctuations that matter least in the grand scheme, though they create plenty of noise and distraction. A wise analyst, like a wise sailor, always knows the tide's direction. They might use the waves to maneuver, but they never fight the tide. Here's a crucial point beginners often miss. Markets don't just go up or down. There's a third direction, sideways. This is when the market enters a trading range, with horizontal peaks and troughs. It's like a lake, not a river. A period of equilibrium where buyers and sellers balance out. Dow called this a line. Why does this matter so much? Because most trading strategies work for trending markets. For rivers, they fail in lakes. During sideways, trendless periods, many traders get frustrated trying to find direction that isn't there. Sometimes the wisest decision is recognizing you're looking at a lake, not a river, and simply stepping aside. Doing nothing. So now we have our trend definition. We know there are 3 types and 3 directions. But how do we actually see them on a chart? And where do trends pause or reverse? This brings us to the next fundamental building block, the battlegrounds. Every story needs a setting, a landscape. In markets, that landscape is defined by 2 invisible forces: support and resistance. A support level is a price below the current market, where buying interest is strong enough to overcome selling pressure. It's a floor. Think of it as a trampoline. When price falls to that level, it tends to bounce back up. This floor usually forms at a previous low point on the chart. A resistance level is the opposite, a price above the market where selling pressure overcomes buying interest. It's a ceiling. When price rises to that level, it often gets turned back down. This ceiling typically forms at a previous peak. In a healthy uptrend, we see a rising staircase of support and resistance. The old ceiling becomes the new floor. In a downtrend, we see a descending staircase. The old floor becomes the new ceiling. But this isn't just abstract geometry. There's fascinating human psychology at work here, and understanding it unlocks why support and resistance are so powerful. Imagine a stock trading sideways around $50 for a few weeks, then suddenly shooting up to $60. 3 groups of people are watching, and their emotions create the magic. Group 1, the buyers who bought at $50. They're happy but kicking themselves. I should have bought more. If it ever comes back to 50, I'm loading up. Group 2, the sellers who sold at 50, or worse, shorted it, betting it would drop. They're filled with regret, realizing their mistake. Please, just let it come back to 50 so I can get out without a loss. If it does, they'll buy to cover their shorts, adding to buying pressure. Group 3, the uncommitted who watched from the sidelines. They saw it at 50 and hesitated. Now at 60, they're drowning in fear of missing out. If I ever get another chance at 50, I won't hesitate. See what happened. All 3 groups, for completely different emotional reasons, greed, fear, regret, decided to do the same thing. Buy if it dips back to 50. That $50 level has become a psychological battleground, a floor of buying interest. It's become support. The same logic works in reverse for resistance. A previous peak becomes a ceiling of selling pressure created by the emotions of those desperate to sell at that price. The more trading at a certain level, and the more recent it is, the stronger that support or resistance becomes, because more people have emotional investment in that price. And here's one of the most elegant concepts in technical analysis: the reversal of roles. What happens when a powerful resistance ceiling, say at $100, finally breaks, when price pushes through to $105? That old ceiling at 100 now becomes the new floor. Why? Same psychology. Everyone who sold at 100 realizes their mistake. Every short seller is in pain. Everyone on the sidelines feels left behind. On the next small dip, where will they all look to buy? Right at that old resistance level of 100. A broken ceiling becomes a new floor. A broken floor becomes a new ceiling. This principle constantly shapes market trends. Now that we understand the landscape of support and resistance, we can see the stories that unfold. In charting, these stories are called price patterns, recognizable shapes appearing on charts that help forecast whether a trend will likely continue or reverse. Don't think of these as abstract drawings. See them as the great dramas of the market, the visual record of the epic battle between buyers, the bulls, and sellers, the bears. There are 2 main categories. First, reversal patterns, signaling a major trend is ending. Second, continuation patterns, suggesting the market is taking a brief rest before continuing its original path. The art is learning to tell the difference. Let's start with the most famous reversal pattern, the head and shoulders top. Picture the story of a powerful king losing his throne. The market's been in a strong uptrend for months. That's the setup. Bulls are in complete control. First, we see the left shoulder. The market rallies to a new high, then pulls back on profit-taking. Normal. The kingdom is strong. Then comes the head. Bulls gather strength and push to an even higher high, the peak of the kingdom's power. Everyone's euphoric. But then the market pulls back again, down to a similar level as before. Now comes the critical moment, the right shoulder. Bulls try one more time to rally, trying to reclaim former glory. But this rally is weaker. It fails to reach the height of the head. This is the first major weakness signal. It's the king's army making one last tired charge and being repelled. These three peaks, the left shoulder, the higher head, and the lower right shoulder, form the pattern. But the story isn't complete until the final, decisive blow. The two low points of the pullbacks can be connected with a line called the neckline. Think of it as the castle wall. The sell signal, confirmation that the king's been dethroned and a new downtrend has begun, occurs when price breaks below that neckline. The castle wall is breached. The uptrend is over. The head and shoulders pattern beautifully shows a powerful trend losing momentum, failing on its final advance attempt, then decisively breaking down. The inverse version, with three troughs instead of peaks, signals a major market bottom and a new uptrend beginning. Another classic reversal story is the double top or double bottom. This is the story of a second chance and a final failure. Imagine the market rallies to a peak at $120, then pulls back. This is our resistance ceiling. Bulls, undeterred, launch another assault on that 120 level, trying with everything to break through. But they're turned back again. That second failure is key. It's like a boxer getting knocked down, struggling back up, then getting knocked down again for the final time. The inability to break through that resistance on the second attempt shows buyers have exhausted themselves. Bears are now in control. The reversal confirms when price breaks below the low point of the trough between the two peaks. This M-shaped pattern is a double top. Its opposite, a W-shaped pattern, is a double bottom, a powerful signal that a downtrend has ended. Now what about when the market's just catching its breath? These are continuation patterns, telling the story of a pause, not an ending. The most common are triangles, flags, and pennants. Imagine a triangle. After a strong move up, price action starts narrowing. Peaks get slightly lower, troughs slightly higher. The market's coiling like a spring. The battle between bulls and bears reaches temporary stalemate, but energy is building within that narrowing range. Usually, the market eventually breaks out of the triangle in the same direction it was heading. The triangle was just consolidation before the next leg. Flags and pennants tell similar stories. After a sharp, nearly vertical price move, the flagpole, the market trades sideways in a small, compact pattern briefly, a little rectangle, a flag, or a tiny triangle, a pennant. This is just the market resting after a sprint, before taking off again. Learning to identify these patterns, head and shoulders, double tops, triangles, is like learning to recognize key plot points in a story. They give clues about what might happen next. But a story is more than plot. It has emotion, intensity, voice. To understand that deeper layer of the market's narrative, we need our next tools: volume and oscillators. First, volume, simply the number of shares or contracts traded in a given period. Think of volume as the market's voice, telling you how much conviction, how much emotion is behind a price move. A price move on low volume is a whisper, tentative, uncertain, maybe real, maybe not. But a price move on high volume, that's a shout. It signals commitment, enthusiasm, participation, lots of people placing bets with conviction. Volume should always confirm the trend. In a healthy uptrend, we want volume increasing as prices rise and decreasing as prices pull back. We want to hear the market shouting on the way up, whispering on the way down. This tells us enthusiasm is with the bulls. If you see the opposite, prices rising but volume drying up, it's a warning. Like a party where music's still playing but people are starting to leave. Energy is fading. The trend may be in trouble. When analyzing chart patterns, volume is your truth detector. A breakout on huge volume surge is far more likely to be real and significant than one on weak volume. In futures markets, there's a cousin to volume called open interest. The total number of bets on the table, contracts still open and not closed out. We look for open interest to rise in a healthy trend, telling us new money and new players are entering, fueling the move. If prices are rising but open interest is falling, people are closing bets and leaving. Another warning that the trend's foundation is weakening. So volume gives us the market's voice. Our next tools give us the market's heartbeat. These are oscillators. Imagine the market like a rubber band. You can stretch it up, stretch it down, but only so far before it's likely to snap back. Oscillators are mathematical tools showing us how far the rubber band's been stretched. They measure speed and momentum of price movements, oscillating between two extremes, usually plotted at the chart's bottom. When the oscillator reaches the upper extreme, the market is overbought, moved too far, too fast, gotten overexcited, might be due for a rest or pullback. Doesn't mean sell immediately, but signals caution. The rubber band is stretched tight. When the oscillator falls to the lower extreme, the market is oversold, fallen too far, too fast. Pessimism has gotten extreme, might be due for a bounce. The rubber band is stretched the other way. Many popular oscillators exist: the relative strength index, stochastics, the MACD, or moving average convergence divergence. They all measure momentum slightly differently, but the core concept is the same. They're the market's heartbeat monitor. This leads to one of the most powerful signals in technical analysis: divergence. Huge clue. Divergence occurs when price makes a new high, but the oscillator fails to make a new high. Think about that. Price is still climbing, but the momentum, the energy behind the climb, is weaker than before. The heartbeat is getting fainter. Classic warning that the trend is running out of steam, like a runner still moving forward but clearly exhausted and about to collapse. Price is telling you one story. We're still going up, but underlying momentum is telling you a different, more truthful story. We're losing power. This divergence between price and momentum often precedes major trend reversals. Before we leave our toolkit, there's one more essential tool, perhaps the most widely used: the moving average. If daily price action is the market's noisy chatter, a moving average helps smooth out that chatter to hear the underlying conversation. It's simply the average price over a specific number of periods, say the last 50 days or 200 days. This creates a single, smooth line on our chart. Incredibly useful. It acts as a dynamic, curving zone of support or resistance. In an uptrend, prices often pull back to the moving average line and bounce off it, as if it were a magnetic floor. In a downtrend, it acts as a magnetic ceiling. The most basic signal is a crossover. When price, trading below its moving average, decisively crosses above, it signals the trend may be turning from down to up. Crossing below signals the trend may be turning down. Traders also watch when a shorter-term moving average, like the 50-day, crosses above a longer-term one, like the 200-day. This is famously known as a golden cross, considered very bullish long-term. The moving average helps define trend in a clear, objective way. If price is above its 200-day moving average, the long-term trend is generally up. Below, the trend is down. It cuts through daily noise and keeps focus on the tide, not just the ripples. We've covered a lot. We started with 3 unbreakable rules. Learned Dow's trend definition. Explored the psychological battlegrounds of support and resistance. Learned to read chart pattern stories. Added color and context with volume, oscillators, and moving averages. Learning these tools is one thing. Being a craftsman is another. This is where we reach the grand synthesis of our journey. A great technical analyst, as John Murphy teaches, never relies on a single tool or signal. That's a recipe for disaster. Instead, they look for confluence, Moments when multiple, independent tools all tell the same story. Imagine you see a head and shoulders top forming a bearish story. First clue. Then you look at volume. Volume on the final rally to the right shoulder was weak, much weaker than on the head. The market's voice confirms the weakness. Second clue. Then you check your oscillator, the RSI. You see bearish divergence. Price made a higher high at the head, but RSI made a lower high. The market's heartbeat confirms momentum loss. Third clue. Finally, price breaks below the neckline on a huge volume spike. See the power? Not just one signal. A convergence of evidence. Chart pattern, volume, and oscillator, all singing the same bearish song. At this moment of confluence, the chartist can act with greatest confidence. Not because they're certain about the future, nobody is, but because the probabilities have shifted dramatically in their favor. The book provides a kind of technical checklist, a systematic way to look at a chart, starting with the biggest picture, the long-term trend, and gradually zooming in. What's the major trend? Where are key support and resistance levels? Any major patterns developing? What's volume telling me? Are oscillators confirming price action? This disciplined, multi-layered approach separates professionals from amateurs. It's about building a case, piece by piece, until the market story becomes clear. Technical analysis, in the end, isn't a crystal ball, not a magical system for getting rich quick. It's a methodology, a discipline, based on the simple idea that the market's past and present behavior gives us powerful clues about its most probable future path. It's a craft combining art and science, rooted always in the timeless, unchanging reality of human psychology. As we step back and reflect on the world John Murphy opened up for us, what's the single most powerful lesson? For me, it's this. Technical analysis isn't about predicting the future. It's about managing risk and identifying probabilities. A profound mindset shift. The amateur asks, what's the market going to do? The seasoned technician asks, where's the trend now? And where's the point I'll know my thesis is wrong? The beauty of a trend line, support level, or moving average is that it gives you an objective line in the sand. A framework for making decisions based on evidence, not emotion or hope. It lets you say, I'll stay with this uptrend as long as price remains above this trend line. If it breaks, my story changed and I'm out. This discipline, this focus on risk management, is the true secret of longevity in markets. These principles are more relevant than ever today. Markets are faster, more global, more accessible than Murphy could have imagined when he started. We have stocks, forex, crypto, countless derivatives, all trading around the clock. But what hasn't changed? Human nature. The fear and greed driving markets a century ago are the same emotions driving them today. Just faster. And because charts are simply a picture of that human emotion, their lessons are timeless. The head and shoulders pattern on a Bitcoin chart tells the exact same story as one on a railroad stock from 1930. So how can you, a curious 17-year-old, begin applying these ideas today without risking $1? 3 simple, practical actions. First, pick a stock, commodity, or cryptocurrency that interests you. Don't buy it. Just go to a free charting site, like TradingView or Yahoo Finance, and pull up its chart. Set it to a 1-year daily view. Your only job, answer one question based on Dow's definition of peaks and troughs. What's the primary trend? Is the tide generally coming in or going out? Just practice seeing the main direction. Second, on that same chart, try drawing one simple trend line. Find 2 clear low points in an uptrend and connect them with a line. Extend that line to the right. Or find 2 clear high points in a downtrend and connect them. Now just watch what happens over the following days and weeks. Does price seem to respect that line? Bounce off it. Treat it as a floor or ceiling. You'll be amazed how often the market seems to remember where that line is. Third, add one moving average to your chart. A 50-day moving average is a great start. Just look at it. Is price currently above or below that smooth line? Notice how during trends, price often comes back to kiss the average before moving away again. It's a simple visual anchor, instantly telling you if bulls or bears have the upper hand in the intermediate term. Charts don't create market behavior. They're simply a mirror, reflecting the collective hopes, fears, and decisions of millions of people worldwide. Learning to read them is like learning to understand the human heart on a massive, global scale. It's a skill, teaching you about psychology, probability, and discipline. And that's a skill serving you not just in finance, but in understanding how the world and the people in it truly work. That was a summary of Technical Analysis of the Financial Markets by John J. Murphy. We've walked through the core principles today, but honestly, a summary can only ever be a map. The real adventure happens when you decide to explore the territory yourself. It's in the quiet moments of study, when a particular pattern or simple concept clicks in your mind in a way you never expected. This overview is designed to help you decide if this journey is one you want to take. If anything we've talked about today sparked your curiosity, I encourage you to pick up a copy. Reading it isn't just about learning. It's an experience that can fundamentally change how you see the rhythm of the world around you. You can find a link to the book in the description below. Also, if you found this exploration valuable, it would mean the world to me if you'd click that like button and subscribe to the channel. That way, you won't miss our next deep dive into another life-changing book from the world's most successful minds. Let's keep learning and growing together.